I'm Scarlet Fu. This is ETF IQ, where we focus on the access, risks, and rewards offered by exchange-traded funds. "2020 Vision." Global macro investor TPW isn't looking through rose-colored glasses. It makes the case for why the America First trade still has legs. Hoping for a roaring 20s? We'll show you how to get there without flappers or bathtub gin. You'll need more than that cheap index fund that did so well in the last decade. And remember the old saying, be kind, rewind? We've got a blockbuster ETF that bets on the U.S. consumer. Now, love them or hate them, ETFs are here to stay, and their flows often signal broader market trends. So, of course, our Bloomberg ETF ace, Eric Balchunas, will be here to do the honors. What are you seeing right now as we approach the year end?
Thank you, Scarlett. Yeah, roaring 20s is a great way to describe the leaderboard. They are roaring. Look at who's leading. You've got SPY and the Qs. This is the tip of the spear for the trading crowd. So these will lead a rally, and they are, and they have been. So you see a lot of money pouring into anything that has risk. You've got international here, that's emerging markets, VTS, the whole market, EM. There's a couple of Vanguard in here that could be tax-related, but they're so overwhelmed by the flows going in legit into risk-on ETFs. Now let's check out, is this a trading crowd move or is retail? What's retail investors, mom and pop, what are they doing? Here's our trader versus allocator chart, and you can see both are about even, and you rarely see this kind of unity between the traders and the allocators. Look how normally they're doing on different pages. The allocators do their thing, but that's a good sign. That tells you everybody is at the party. They're using ETFs like SPY, VTI, IEFA, and EFA. Now let's look at equities versus fixed income. Remember, it had been the year of the fixed income ETF for many, many months. In fact, here was a $45 billion gap. But look at the surge, the late surge by equity ETFs. Now it is a dead heat with only 10 days left. And Scarlett, don't be surprised if equity actually turns this into a trouncing and wins by 10 or $20 billion. And
you end up winning a bet as well. All right, let's bring in Jamie Gardner, co-founder and COO of TPW Investment Management, and Sarah Ponczak, a cross-asset reporter for Bloomberg News. Jamie, a lot of people in the ETF world call 2019 the year of fixed income. But as Eric showed us, this late surge in inflows into equity funds really has allowed them to catch up with fixed income flows. What's your take on this?
Yeah, so not surprising to Eric and not surprising to us that equities are going to take over fixed income. We were on the show a couple months ago and talking about the fall risk asset rally. And we've kind of moved that to our 2020 outlook, which is reflation 2020. So we were looking at global growth bottoming, was the key there, looking at easy monetary policy and fiscal policy, and then earnings expectations next year are going to beat. So with that all in mind, you're starting to see the flows catch up to the fundamentals and what people are seeing in the markets. And so we really think that these flows are going to continue into the first half of 2020 and maybe all year 2020. So this is not just a late push at the year end.
Maybe all year 2020. Sarah, how much does FOMO play into this? Because this time last year, no one really thought that 2019 was going to be a blockbuster year. People were panicking.
Right. So we're seeing the mirror image of that now, it seems. And FOMO can certainly be a part of it. If you look at the latest Bank of America Merrill Lynch Fund Manager survey, they saw that over the past 2 months, the largest jump in growth expectations on record. But the fundamentals, as Jamie alluded to, we're seeing a confirmation of it. We've seen a bottoming in global PMI. We've seen an uninversion of the yield curve. We see continued labor market strength in the United States. And JP Morgan has actually been talking about this phenomenon of 3-year cycles, the idea that you have a mini crisis every 3 years and then you get a recovery. In 2011, 2012, Eurozone crisis. In 2015, you have the devaluation of the yuan. We had it again at the end of 2018. And if that's true, if you believe in the phenomenon, then what that means is we can actually be in a bit of a recovery stage right now.
That is amazing to think about. And how does that square with your picks? I asked you to bring your 5 ETFs that you like. One of them on here is value, IUSV. Why value given that optimism, and why that specific ETF?
Yeah, so one of the charts that Bloomberg put out a few weeks ago too was that the expectations for the S&P next year are 4%, which is the lowest in 15 years. So again, that supports our look that people and the market is under expecting what's going to happen next year. And we're seeing a shift to value, cyclicals, and size. So IUSV is our value pick. For that, it's a core pick for ours, so it's 4 basis points, which is incredible that we're able to get value exposure for 4 basis points. And it's kind of the vanilla version of it. I know there are other value picks you could do, but for our core positioning, we want that. With small cap, we have IJR, also another low cost, 7 basis points. It's pretty incredible that we're able to get this exposure. Been in the ETF industry for over a decade,
right,
and the products are getting better and better and cheaper. It's kind of, we're now able, if Jay Pulaski does, we're the chefs and ETFs are the ingredients, my partner, and we're able to do farm to table organic now for the price of fast food, which is just incredible.
Love the metaphor.
Yeah.
Love the metaphor. And I heard low cost a couple of times there. Value clearly was unloved over the past year. International was also pretty unloved, Sarah. But the reasoning here for why international may see its time to shine right now is because you've got an accommodating Fed, you've got a truce in the trade war, and reportedly, the Brexit cloud has lifted, although it seems to have been replaced by another cloud.
Right. After the UK election, it seemed like the risk of a no-deal Brexit was off the table. Now maybe it is back on the table. But what this is really representative of is that, yes, we have had such disparity in valuations between international funds and also U.S. funds because we have just seen such immense U.S. outperformance. But risks still do remain, whether that is the advent of potentially a no-deal Brexit. Yes, we do have that phase 1 trade deal, but now we're looking forwards to a phase 2 trade deal. What does that mean? Can more tariffs actually be put back in place? It does seem like a consensus trade for next year is international over U.S. However, I will say I spoke with one investment manager at BMO earlier this week, and he did mention that the U.S. is still their favorite part of the U.S., although Europe looks a little bit more attractive. BlackRock said the same thing this past week, too. Still favor U.S., but Europe is starting to look a little bit more attractive.
Jamie, you own Europe. You guys tend to lean international. IEUS, I believe, is the one you use as a small cap. Why small caps when you're going to play this?
Yeah, so we actually favor rest of the world over the U.S., so a little bit opposite of what she's been talking to other managers doing. And we think there's a huge opportunity there. One, it's got an industrial tilt, which is great for global growth bottoming, the small cap. It also has a third of the exposure in UK. We've avoided the UK for the past 2 years and really focused more on the Eurozone. Now we're doing all European by IEUS. And that really gets its exposure to kind of the growth in the bottom of global growth, really helps industrials, helps Europe, helps an underloved area of the market in terms of flows. You're seeing, you don't see anyone looking at Europe, let alone small cap. Another holding we do have is European financials, which is, if you're talking about very underloved, that's been a space that, price to book under 1, has been incredibly underloved, got a value play there as well. And
very quickly, you also like EMQQ and China in particular.
Yeah, EMQQ is actually a very interesting play on the emerging market consumer. Our firm's TPW, Tripolar World, which really talks to the regionalization. And the regionalization of the emerging market consumer, the way to play that is not what they're buying, because they're going to be buying that from U.S. companies, big conglomerates. It's what platforms are they using. So you get Alibaba, Tencent, Mercado Libre in there. So you really get companies that have exposure to the emerging market consumer.
Got it.
That's more of a niche play for us, not one of our big core holdings, but an interesting play.
Jamie Gardner of TPW Investment Management, thank you so much. And also Bloomberg's Sarah Ponzik. Now, coming up, I speak with Bloomberg opinion columnist Nir Kaysar. He says, don't expect the U.S. equity market that roared this decade to necessarily repeat in the decade ahead. And one ETF trend that caught our attention this week, muni bonds. The $49 billion ETF market had yet another record year of growth. These funds have seen more than $10 billion pour in this year. That is a 51% increase from last year. A reminder, by the way, that you can find that chart and all the other ones we feature on the Bloomberg at GTV Go. This is ETF IQ. I'm Scarlet Fu. This is ETF IQ. Now let's take you through the ETF life cycle, which has 3 main stages. Step 1 is the filing. BlackRock registers the iShares MSCI Kuwait ETF. This will be the first U.S. listed ETF with specified exposure to Kuwait. It'll be market cap weighted with more than half of its exposure in financials. Step 2 is the launch. The PIMCO Enhanced Short Maturity Active ESG ETF is now live. Ticker EMNT will be similar to PIMCO's $13 billion Mint fund, but with an added ESG tilt to the investment process. EMNT will be actively managed. And for some, the final stage is liquidation. Invesco retiring 42 funds with a total of $1 billion in assets. It's all part of Invesco streamlining its products after acquiring Oppenheimer funds this year. The vast majority of these funds will be removed from exchanges in February. It's time to get passive aggressive, where we track the tensions between active and passive investing. Now, simply buying the S&P 500 over the past decade has paid off big time. The index has returned 13% a year from 2010 through this November, including dividends. Can you use the same passive approach in the 2020s? Bloomberg opinion columnist Nir Kaysar says history suggests no. Nir is founder of Unison Advisors and joins us now from Washington. Nir, it's pretty clear that for anyone who's invested and exposed to the U.S. market through an index fund or an ETF, that's all they really needed. And judging by the numbers, they were pretty happy with the returns they got. Break down how the returns for the 2010s look and compare to previous decades.
Hi, Scarlet. Yeah, it's safe to say it's been an amazing decade for U.S. stocks. And anyone who was exposed to U.S. stocks did great. It's the fifth best decade going back to the 1880s. So it was great. It was a great decade, and that sparked a lot of discussion in recent years about what drove the returns from the market. The theories that I hear most are that it was the Fed, it was the cheap money policy that drove the market higher, or that it was FANGs, it was a small subsection of high growth companies that lifted the market higher, or that it was stock buybacks. And I went and looked at the numbers, and I don't think any of those explanations are particularly good ones. I think really what drove this market was just historic broad-based earnings growth. When you look at that 13% a year that you mentioned, roughly 2% of it came from dividends, roughly less than 1% of it came from valuation expansion, and a whopping 10% of it came from just good old-fashioned earnings growth. And so obviously the question that begs is, can you expect that earnings growth to repeat into the next decade? And my guess is it won't.
Why? Why do you say that?
Well, one of the things that's underappreciated is that earnings are very volatile. I think in a lot of people's imagination, stock prices is where the volatility comes from, and earnings are sort of the fundamentals underneath them are sort of the stabilizers. But when I went back and I looked at the 150-year data set that we have, and I looked at year-over-year changes in earnings and stock prices, what I discovered is that earnings are 3 times more volatile than stock prices. And this is not a relic of the ancient past. The 2 most severe earnings recessions of the last 150 years, 2 of the 3 most severe were in 2000 and 2008, so the last 2 busts. And so there's just a lot of volatility in earnings, and the record growth that you've had over the last decade, if history is any guide, I think tells you that it's probably not going to repeat.
All right, Nir, this bull market, of course, was also at least partially responsible for the switch from passive to active, for the rise of ETFs and low index fees overall. We saw a $500 billion to $1 trillion swing in flows from active to passive, which is incredible. Going forward, is that the path of least resistance? Do you expect that trend to continue along that trajectory?
I do think so. I think there'll be a lot more adoption into lower cost products. There's some folks have mentioned that there's still a lot of room to go from high-priced products to low cost. So I think that will continue. But Scarlett, there's an interesting thread running through these 2 discussions, which is that I think the bigger challenge for investors over the next decade will not be going to low-fee products. That's going to be the sort of the low-hanging fruit. I think the harder thing will be for them to control themselves and not chase performance. And when we were talking about the S&P, it's going to be very tempting for investors to look in the rearview mirror and say, oh, look, the S&P has done great. That's where I'm going to put all my money. But that's likely to be a mistake. And so I think the challenge in the decade ahead will not be fees so much. It'll just be not chasing returns.
Is it easier to not chase returns when you're invested through passive products?
That's a great question. We need more evidence along those lines, but I think the evidence that we do have is showing that the answer is yes. In general, there tends to be a correlation between lower fee products and better behavior. Presumably, we don't exactly know why, but presumably because investors who are smart enough to know that they shouldn't overpay for financial products are probably also smart enough to know that they should just sit in their seat and let time do its magic. But there's also evidence that lower volatility helps, regular investing helps, and also just not paying attention. Benign neglect is helpful as well.
Benign neglect as an investment strategy. All right, Bloomberg opinion columnist Nir Kaysar, thank you so much for joining us today from Washington. Really appreciate it. Coming up, if you could turn back time, you're certainly going to love our 1980s themed ETF that has turned heads since its inception. And for drill down into all of our ETF content, check out bloomberg.com/markets/ETFs. This is ETF IQ. I'm Scarlet Fu. This is ETF IQ. Now, for every ETF that offers exposure to a sector, others are usually quick to follow suit. Technology is the best performing sector in the U.S. and around the world this year and this decade. Looking ahead, Defiance ETFs has identified what it sees as the leading edge of tech, quantum computing, and built a product around it. Defiance's Paul Dell'Aquila is here with us now, but before we talk to him, Eric Balchunas is going to give us the drill down into Defiance's QTUM fund.
Thank you, Scarlet. Yeah, this is one of those ETFs where I had to Google what it even means when I saw that it came out. But basically, these are just very big, fast computers that can take on more complex problems. They use quantum shifts in a way to be faster than electricity. And this is supposed to help breakthroughs in science and finance and a lot of industries. So this is what it's trying to get to capture. It's pretty small at 13 million. It's got 40 basis points as the fee. Pretty low for a theme ETF, to be honest. Let's look at the holdings. Now, you're probably not going to recognize a lot of these companies. You might recognize some. But the bottom line is it's got a lot of tech and semis, but only 18% overlap with XLK. So XLK gets you some of this, but not the bulk of it. And it's also got like I said, 50% semiconductors. Let's compare it to the closest thing I could think of, which is Cathie Wood's ARC-W, which is next generation internet. It's not even that close of a comparison, but just to give you an idea of another type of ETF like this. You can see here the active share to XLK is important. Also the cost, it's cheap again for one of these. And then look at the 1-year return, 44%. That really is much better than the market. And Scarlet, to me, that's an important thing because a lot of people may not even understand what this is, but they do understand what 44% returns are.
Right, and that'll lead to an inflow of assets as well. Still with us is Paul Dell'Aquila, president at Defiance ETFs. So Paul, do investors really understand what quantum computing is, or do they just like the sound of the Google definition that Eric came up with?
So thank you both for having me on the program again. And I do think this is a very early concept for most investors to comprehend. And that was what we spent the last year doing, is really educating. I think the breakthrough with Google Sycamore, that's their quantum computer, in October has brought a lot of that news to the forefront, where they're able to solve a computation that would have taken a normal computer 10,000 years and did it in under 300 seconds.
We talked earlier, you said that Thai cave incident with the divers is where this would come in handy. Can you just explain that as a real world problem that it solved or can solve?
Absolutely, Eric. And you mentioned complexity, and that's what quantum computer can ultimately solve. Yes, it's going to be faster, but it's about the complexity of it. Most computers right now work in a linear fashion. In other words, they're solving for one data point. What you could do with something that's a little bit more complex, like the Thai cave diver situation, you had to look at weather patterns. You had to look at how much oxygen the kids actually had in the cave before bringing them out. How long will it take the divers to get there? All of these factors. You could input that into a quantum computer and get the actual solution, as opposed to a number of solutions done in many different linear fashions.
Okay, that makes sense, and I like the live example here. When we looked at the members of the fund, you've got some big names like Microsoft, Apple, Texas Instruments, along with smaller companies, and it kind of feels like a catch-all for tech. How far along are we in the rollout of quantum computing? I mean, at what point will it start to touch our everyday lives where people can point to specific examples that they can relate to, not just what they read about once in a while?
Sure, and I think the reality is this isn't something that we're probably going to have in our living rooms anytime soon, but it is something that data scientists and big corporations are going to be able to access through the cloud and whatnot. You're already seeing that. So IBM is pointing to actually being able to show revenue in the next year or so, being able to be derived directly from quantum computing. And I mentioned the breakthrough that Google had. So it's going to be much more prevalent as the years go on. But there is a machine learning component to the fund as well, which is happening right now. So there's some current aspects to it that we're very excited about.
Now, I want to shift to your other related ETF, 5G. It's the first 5G ETF. It's pretty big. It's like over 100 billion at this point. I spoke with John Butler, who's our analyst who covers this. He's very excited about 5G. He thinks it's a big deal. I showed him the holdings. His one critique was it leans a little heavy to semis. He thinks there's maybe a little too much semiconductors. What's the rationale behind going so much into that subsector?
So the way we looked at it, we try to capture the entire ecosystem of the 5G build out. So in addition to semis, which we do have, we call that more core equipment than anything else. So you have radio access equipment, you have semiconductors in there. We also have mobile network operators, the Verizons and AT&Ts of the world, and the REITs and the infrastructure plays. So it rolls back to my original premise of the fund. It is very difficult to find the one or two equities that are going to be able to capture this 5G build out. there's such a big ecosystem around it that in ETF, because it's broad and capture more sectors, you're going to be able to get all of those under one umbrella as opposed to buying a bunch of individual equities.
All right, we have time for one more question here. I got to ask you about a new fund here with the best ticker, Diet. It's small. It's only got about $2.5 million in assets, but the idea of it is basically the future of food.
Correct. Diet just launched a little under a month ago, about 3 weeks ago. The reality of what we were trying to produce with this fund is food innovation and sustainability. We can all agree that people are being more cognizant of what they're putting into their bodies and how that's being impacted by the environment, way of food production. So what we try to do with Diet is provide the leaders of that industry under one ticker that is a very differentiated exposure than what you're going to have in, say, a core S&P 500. It's a very, very different portfolio.
And of course, we saw that Beyond Meat is in there as well. Paul Delaquila of Defiance ETFs, thank you so much.
Thank you both for having me.
Now, the ETF industry has something for everyone, including those who are big on nostalgia. So in this week's There's an ETF for That, Eric and I revisit our analog childhood. The Vanguard Consumer Discretionary ETF trades under the ticker VCR in a nod to one of the best-selling consumer technology products of the 1980s. VCR is a market cap-weighted fund with some $3 billion in assets that tracks the U.S. consumer discretionary sector. Of its roughly 300 names, retail makes up 40% of the fund, while internet companies are just over a quarter. The remaining balance consists of mainly apparel, hotel companies, car makers, and home builders. Amazon is the single biggest holding, comprising a fifth of VCR. Home Depot, McDonald's, Nike, Starbucks, and Lowe's are in the top 10. As a Vanguard fund, VCR offers a low expense ratio and only discloses its holdings on a monthly basis. Over the past year, VCR has trailed the S&P 500 by a few percentage points. But if you go back to its inception in 2004, VCR outperforms, with the fund pulling away from the broader market by 70 percentage points. This is a plain vanilla fund, and as such, gets a green light in the Bloomberg Intelligence traffic light system. That looked just like Friday Night Videos, by the way.
Yeah, it also reminded me of the video. I used to tape movies from the rental store and keep them at home. And
well, you had two VCRs so that you can do the dubbing?
I was that guy, yeah.
Well, I also had Ferris Bueller's Day Off on tape that I watched a lot after school. So there you go. That does it for Bloomberg ETF IQ. Be sure to catch us each Wednesday at 1 p.m. New York time, 6 p.m. in London. This is Bloomberg.